All right, ready? Let's start the interview. All right, you gotta sit back. Josh Neitz here today with my right-hand man.
Sid.
Sid what?
Sid Neitz.
Sid Neitz. And we're gonna talk about mortgage rates today. How's that sound?
Good.
Yeah, that sounds good. So we're gonna talk about the first misconception. And that is that mortgage rates are a direct correlation. They go up and down when the Fed raises and lowers rates. Is that true?
Yeah.
No, that's not true. That is not true. So if the Fed raises rates a quarter point, interest rates may only go up 0.1% or something like that. But it's not a direct correlation. Do you understand that?
Yeah.
Yeah, we do. So the next thing is it's April 2nd today, 2022, and the 30-year mortgage is at 4.4%. The last time it was at this rate was in February of 2019.
I need to plug in.
Okay, oh yeah, we gotta plug it in. So we opened up 2022 this year in January at 3.2%, and we're already up 1.2% in the first quarter. Is that a lot?
Yeah.
Yeah, that's a lot it went up. That's not good for people who want to buy houses, is it?
But it's already plugged in.
Okay, so historically over the last 30 years, the biggest gain in the year was 2.5% back in 1979. Guess who was born in 1979?
Me.
No.
Daddy.
Daddy was born in 1979. So if we tied that record again this year, we'd be at 5.7% by the end of the year. Now let's talk about affordability that is leaving Americans behind in buying houses. You want to do that?
Yeah.
Do you want to buy a house when you get older?
Yeah.
I would love that too. So here's what we're going to talk about.
Okay.
April 1st in 2000.
Yeah.
April 1st in 2021.
Yeah.
Prices were 25%. Prices were 25% less.
I don't want to anymore.
And interest rates were 3.2%. So an entry-level house costs $240,000. And at a 3% down payment, the monthly mortgage was $1,446 a month.
Okay.
Could you afford that?
Yeah.
I think you could too. But this year, 1 year later, April 2nd, that same house now costs $300,000. And the mortgage rate is 4.4% today. So that payment is $1,980 a month. That's a $534 increase in 1 year.
Okay.
That's a lot, isn't it?
Yeah.
You think that's going to be tough for people to make up?
Yeah.
Yeah. So if by year end we go up another 9% in prices and interest rates go up to say 5%, a house would cost...
I would want it for you.
Okay, thank you. A house would cost $327,000 and the interest rate would be 5%. So that house would now cost $2,264 a month. And these include taxes, interest, principal, and insurance. So that is a $284 increase from today to the end of the year. What do you think about that?
I took a picture.
All right, we're pausing it.
Okay.
All right, come sit back down for 1 more minute. That's a pretty big increase. If it went up to 5.7%, the interest rates, that would be an increase in roughly $422 a month. You'd have to sell a lot of lemonade at your lemonade stand for that, wouldn't you?
Yeah.
Yeah. So historically, we're still at low interest rates for mortgage rates, even though it seems like we're really high because we have been spoiled the past 10 to 12 years. But we still are pretty darn low. It is time to act quickly though as prices keep going up and interest rates going up, and as you can see by these numbers, making affordability really tough. So here's some ideas, Sid, of what we can do to get people houses. Would you like to partner up with a buddy? Who would be a buddy you would like to buy a house with at school?
Ronan.
Ronan. So Sid would like to buy a house with Ronan, and you guys could be roommates, huh?
Yeah.
So instead of paying maybe $1,200 or $1,300 a month each for rent for 1 bedroom, you guys could team up, get a house, and your mortgage payment would be a lot less and you'd be with your buddy. Is that pretty cool?
Yeah.
Yeah, that's a good idea. Another thing is if you do have a family, go all in right now because as you can see by these numbers, I think prices are just going to continue to go up. Maybe you can have some family members, and there's just a lot of creative ways lenders have right now. And again, you don't need 20% to buy a house to put down. You can do it with as little as 3%, as these examples we were using, or 5%. But back in the day, it was 20%, and now you have mortgage insurance if you don't have 20%. But you don't have to do that. So you don't need a lot of money, but you do need to act now, and prices are going to keep going up, and it's cheaper to own than rent. Okay, so my interview guy's going. Thank you very much. If you guys have any questions, let me know. Love to help you out.